let's have a sesh on the statement of financial position. The statement of financial position is a snapshot of a company's equity, assets and liabilities at a single point in time. You need to think of it like taking a photo, except you're taking a photo of a business now. But that photo tomorrow is out of date. And that photo, like the statement of financial position, is looking at what you own, what you are owed, and what you owe. And it's sometimes called or referred to as the balance sheet, because you're trying to balance total net assets with total equity. With total equity, what it is everything you effectively put into the business in terms of shareholders, so that could be share capital if you've issued shares, or you've got retained profits, being your historical profits you have made over the years the business has existed. Sometimes retained profits are referred to as retained earnings. And you need to balance your total equity, which is adding up all of that, with your total net assets. Note that it's your total net assets, not your total assets, because it's accounting for your assets and anything you actually owe, being your liabilities. So the formula to get to total net assets is non-current assets, being long-term assets, such as property or machines, or it could be vehicles, anything that you have going to hold for over a year. And your current assets, you need to add that on, being your short-term things that you own. And you take away all the things that you owe in the long term, being your non-current liabilities, such as a bank loan, and in the short term, being your current liabilities, such as creditors or any tax that you need to pay. And that, your long-term assets plus your short-term assets minus your long-term things that you owe minus your short-term things that you owe comes to your total net assets. And your total net assets must equal your total equity. It must balance. Let's go through a numerical example of a balance sheet. So here I've drawn in some numbers. We'll start from the bottom. So the total equity, this business, they have had share capital for their shareholders of £15 million. They've also had retained profits, historical profits over the years of £5 million. 15 plus 5 equals 20. So their equity and therefore their total equity is 20. Now this needs to balance with the top side. So non-current assets, property 30. So they own their own property and they've got machines for 10 million. 30 plus 10 equals 40. They've got current assets in the form of cash, 5 million, debtors, money that they are owed, 5 million, and stock, sometimes called inventory, for 5 million. 5 plus 5 plus 5 is 15. So then you need to take away your long-term liabilities. Your long-term liabilities could be your bank loan, for example. It looks like they've taken a bank loan out for 30 million, probably to pay for that property for 30 million that's become an asset as a consequence of that. And then you need to take away your current liabilities. So here we've got creditors, being probably suppliers that you owe for £4 million, and you've got tax to pay for £1 million. 4 plus 1 is 5. So your current liabilities is 5. Now if you do 40 plus 15 minus 30 minus 5, that comes to 20. 20 is your total net assets, and that balances with your total equity of 20. Hence it's called the balance sheet. So everything that you've put into the business, you can find where you have distributed it in terms of what you own in the short and long term, and what you've taken away in terms of in the long and short term, what you owe. And this 20 million that you've balanced in terms of your total equity and your total net assets, well, that is another way of looking at it, is that is the net worth of the business. And that's why you can say the balance sheet or the statement of financial position looks at the net worth of the business. I hope that helps, and I'll see you at the next video. Oh, get in! One take!